Hi everyone, Amy here, welcome. Today we're getting into something really fundamental, finance and investing. Specifically, how you can build wealth, maybe find some financial freedom, but without taking those huge, scary risks everyone talks about.
Hi, I'm Tom. And yeah, it's a crucial topic. We're drawing on some really fascinating stuff today from Monish Pabrai. He's a self-made millionaire, a really sharp investor. We've got insights from a YouTube interview with him.
Right. And we're going to unpack his ideas, these sort of mental models he uses. They're surprisingly simple, but they really challenge conventional thinking about success, about security.
Absolutely. Pabrai runs a highly respected firm, manages over $1 billion.
Hmm.
But the key thing here, I think, is that these aren't just, abstract theories. They're practical tools, things you can actually use to build wealth, but always focusing on minimizing that downside, minimizing the risk.
Okay, so let's jump in. Pabrai is often called the Dhandho investor. Well, that's not a term you hear every day. What exactly does Dhandho mean? Why is it so core to how he thinks?
Right, Dhandho,
Hmm.
a Gujarati word. And it basically means a way of doing business where your downside, your potential loss, is practically zero or, extremely small.
Win big, lose nothing. Is that the idea?
That's pretty much it. He points to people like Bill Gates, Sam Walton, Walmart, Richard Branson. He says they all kind of instinctively followed this path. They found ways to get huge results without betting the farm.
Which is so counterintuitive, right? Because everyone thinks entrepreneurship is betting the farm. Huge risk.
Exactly. And Pabrai just turns that on its head.
Mhm.
He argues that actually real entrepreneurs don't take risks, or rather, they work incredibly hard to eliminate risk, to get it as close to zero as possible before they leap.
Okay, that's a big claim. So what's one of the first sort of core ideas he uses that fits this Dhandho model?
Well, one of the big ones, and it's pretty radical for a lot of people, is cloning. The idea that
Wow.
you don't need some brand new, earth-shattering invention.
You don't need to be the next big inventor.
Nope. He actually says being a great cloner can put you like 95% ahead of most people.
Yeah.
It's pure Dhandho because you're building on something that's already proven. You're minimizing the risk of failure massively.
Okay, examples?
Oh, plenty. Look at Microsoft. Word came after WordPerfect. Excel came after Lotus 123. Bing? Well, trying to clone Google, right?
Uh-huh.
Sam Walton himself said Walmart had basically zero original ideas. He just relentlessly copied competitors. He'd even visit stores he thought were terrible, just looking for one tiny thing they did well, like a candle display he mentioned once.
Wow. Okay.
And Howard Schultz with Starbucks. He didn't invent the coffee shop. He saw the Italian coffee bar culture and cloned it, brought that specific vibe to the U.S.
So it's about finding what works and doing it maybe better or differently or just bringing it to a new market.
Precisely. And he takes this risk idea even further. He makes this claim that a regular 9-to-5 job might actually be riskier than starting your own thing.
Okay, hang on. How does that work? That sounds completely backwards.
Well, his point is about potential. In a job, you might be safe, but are you fulfilling your potential? Are you, as he puts it, getting your music out?
Mhm.
That's the risk of not living the life you could, not using your unique talents.
Getting your music out. I like that phrase.
Yeah. And entrepreneurs, the Dhandho ones, they minimize the financial risk specifically so they can pursue that music, that calling, without risking everything.
Okay, so for someone listening, maybe they feel stuck in that 9 to 5, they have an idea, but it feels like this giant leap into the unknown, super risky. What's Pabrai's advice? How do you start without, jumping off that cliff?
Right, that's crucial. And it leads to his next idea, time allocation. And the big, bold advice is don't quit the day job. Not yet, anyway. Someone else is paying your bills, covering your basics. That reduces risk immediately.
Keep the safety net for a while.
Exactly. He uses this great analogy with Lego blocks for your week. You've got, say, 40 hours for work, blue blocks, sleep, maybe gray blocks, chores, commuting, and then you have your free time. He calls these the orange blocks, Netflix, social media, just chillin'.
The fun stuff, basically.
Yeah. And Pabrai's strategy is you got to carve out time for your startup idea. Let's call those yellow blocks, by drastically cutting into those orange blocks.
So less Netflix, more hustle.
Pretty much. And for your day job. His advice is kind of controversial, but he says aim for just above firing level.
Whoa, really?
Yeah. The idea is to conserve your mental energy for the startup, the thing you're passionate about. And here's the test, the litmus test, he calls it.
Huh.
Those yellow blocks of the work you're doing on your own thing, they have to feel more exciting, more engaging, almost orgasmic, as he puts it, than the orange blocks.
So scrolling Instagram feels better than working on your business idea.
Then maybe that business idea isn't your music. Maybe entrepreneurship isn't your path right now. The passion has to pull you more strongly than the leisure activities.
That really reframes it. It's not just about making money then. What is the point, according to Pabre?
Well, he believes the real purpose of a business should be to deliver something incredible, a product, a service to humanity. Money is just a side effect of doing that well.
Ah, back to getting your music out.
Exactly. It's about pursuing that calling, especially if you're like apparently 85% of people globally who aren't engaged with their day job find a way to serve, to offer value, and the rewards tend to follow.
Okay, so you've got the drive, you've carved out the time. But how do you know if your actual idea is any good? How do you avoid building something nobody wants?
Yeah. Key question. This brings us to rapid prototyping and really listening to customers. Pabre is adamant. Ideas you cook up just in your head in your ivory tower,
Yeah.
they almost never work as planned.
You got to get it out there.
You absolutely have to show it to real people. Get feedback early, often. He tells his own story about starting an IT services company. He had this whole 20-slide pitch deck.
Right.
But when he pitched a big bank, the client kept saying, go back to slide 10. Tell me more about slide 10, because slide 10 solved an extreme pain point they had. That single slide became his entire business focus.
Wow. So the customer basically told him what business to build.
Pretty much. He argues, people quote Steve Jobs saying customers don't know what they want. But Pabre says once they see something, they'll tell you if it's right or wrong. 100%. Think Google Glass versus the Meta Ray-Bans. Ergonomics, how it feels, does it look dorky? Customers figure that out fast.
Listen to the feedback, adapt. Makes sense. But what about the practical side? Running the business day to day, especially if you're bootstrapping, keeping things lean.
Yeah, super important. Cost discipline. This is another core Dhandho principle. Think about Sam Walton again. He supposedly chose the name Walmart, 7 letters, partly because it was cheaper for signage than longer names.
No way. Really?
That's the story. Even luxury giants like LVMH, they might sell expensive bags, but apparently they are ruthless negotiators on things like store leases. The point is, costs are something you can always control. Be frugal where it doesn't impact the customer experience.
Okay, control costs. But things still go wrong. It's not always smooth sailing, is it? People think success happens overnight.
Definitely not. And that leads to resilience and the law of averages. Success requires persistence. It requires lots and lots of swings. You're going to face rejection.
You need thick skin.
You do. Pabre talked about his early days sending out 200 letters a week for his IT startup. He tracked everything. Calls, responses, meetings. Most were no. He even told this amazing story about his daughter trying to get a hedge fund job.
Oh yeah, what'd you do?
She sent out 1,200 physical letters, each one personalized, with a specific stock tip relevant to that fund.
1,200.
Yep. High effort, high signal. Stood out completely. And it worked. It's like cold calling. Maybe 80% say no, but the few who say yes, those are the seeds. You just have to keep swinging.
That's a great lesson in persistence. And it ties back to the idea that you don't necessarily need a ton of money to start, right? People think you need venture capital.
He completely debunks that.
Yeah.
Says 99.99% of startups don't have VC funding. It's not about deep pockets. It's about brain power, resourcefulness.
He took his own start.
Exactly.
Right.
He used, was it $70,000 in credit card lines, $30,000 from his 401k. That was it. And he was cash flow positive in 9 months.
Incredible.
Or Richard Branson starting Virgin Atlantic, an airline. He leased a 747 with basically zero capital up front.
Yeah.
Creative thinking, pre-selling seats, paying for fuel, and the lease later. It's about finding those free lunches, those clever angles.
Okay, so it's resourcefulness, customer focus, cost control. What about mindset? Anything else?
Yeah, he brings up Adam Grant's work on givers versus takers. He strongly believes that givers, people focused on helping others, on contributing value without keeping score, are ultimately the most successful.
Karma, or just good business.
Maybe a bit of both. He says the universe kind of conspires to help givers. His advice: don't do the math, just give. Build goodwill. It compounds over time.
All right, let's shift gears slightly. Say the business is working, it's growing. Now you need people. What are the rules for scaling?
Okay, recruiting. Pabre says for founders like Musk or Jobs, recruiting is job number 1. Absolutely critical.
Get the right people on the bus.
And only the best people. A players hire other A players, but B players, they tend to hire C players, and that's the start of a decline.
Yeah.
So spend huge amounts of time on hiring. He even mentions using things like pre-employment tests, like Caliper or others, to get more data.
And if you make a hiring mistake?
Then fire fast. He says it's actually a service to the person that are likely not thriving and could be great somewhere else, and it's essential for the company. Don't let a bad fit linger.
What are the absolute must-haves in a hire?
Three things, non-negotiable: integrity, intelligence, and a strong willingness to work hard. Energy.
Makes sense. And this Dhandho approach, it's not just for tech, right? You mentioned the Patels earlier.
Oh yeah, the Patels of Uganda story is amazing. This small ethnic group, forced out of Uganda, came to the U.S. and eventually ended up owning something like 80% of all motels.
How?
Dhandho methods. Pure Dhandho. Minimal cost structures, often family-run, low overhead, finding an overlooked niche. It shows you can apply these ideas to boring businesses too. Find an offering gap, like his example of a barber opening shop just one day a week in a town with no barber instant demand could even charge a premium.
Find the gap, fill it efficiently, and how do you protect that business once it's running? Keep competitors out.
Durable moats, like a castle moat. What protects your business? It can be human habit people stick with their trusted barbers.
Sure.
Or things like membership fees, Costco, Amazon Prime. Pabrai mentions even Bill Gates thinks those fees are almost illegal because they lock customers in so effectively. It creates stickiness.
What about Apple? Is their ecosystem a moat?
It has been, definitely. But Pabrai notes the challenges they face now, the intense competition. Maintaining that moat requires constant innovation, which is hard. He contrasts it with IKEA. Their moat isn't tech, it's deep operational stuff. No debt, relentless focus on cost reduction and design innovation in every single store they build. Super hard to copy.
Fascinating stuff on building businesses. But Pabrai's own story, a lot of his wealth comes from investing, doesn't it?
Oh, absolutely. That's where he really made his fortune, applying similar principles.
So let's pivot there. What are the investing fundamentals he stresses? What really matters for getting great results over time?
Okay, for investing, he boils it down to three main things: how much capital you start with, how long your runway is, basically, time, and your rate of return.
Capital, time, return rate. Got it.
And he loves the rule of 72. Just a quick mental shortcut, divide 72 by your annual interest rate, and that tells you roughly how many years it takes for your money to double.
So like 7% return means doubling in about 10 years.
Exactly. 72 divided by 7 is about 10.3. Simple but powerful way to grasp compounding.
And he has this incredible story that illustrates the power of time, the runway.
Oh, the Manhattan Island story. It's fantastic.
Yeah.
So 1623, Dutch settlers buy Manhattan from Native Americans for about $23 worth of goods. People always say the Native Americans got ripped off.
Yeah, sounds like a terrible deal in hindsight.
But wait, Pabrai says, what if they'd taken that $23 and invested it, getting just a 7% annual return? Pretty modest, right?
Exactly.
By 1723, that 23-year becomes $23,000. By 1823, $23 million. By 1923, $23 billion. And by 2023,
I'm almost afraid to ask.
$23 trillion.
Like what? From 23 trillion?
43 trillion, which he points out is roughly 1/6 of the entire wealth of the United States today.
Big. That is absolutely insane. It completely changes how you think about small amounts of money.
Right. And here's the mind-blowing insight he draws from it. If the runway is long enough, the starting capital doesn't matter. He even says the rate of return almost doesn't matter if the runway is long enough. He calculates that even if they'd started with just 2.3 cents instead of 23 teasers over 400 years at 7%, it still would have grown to $23 trillion.
So time. Time is the real superpower here, more than anything else.
Time and compounding. It's the ultimate free lunch in finance, but it requires immense patience, which most people lack.
So, okay, bringing this down to earth. For you listening, maybe just starting out, maybe you don't have a lot to invest. What are the actionable steps here?
It really boils down to a few simple, powerful things. One, spend less than you earn. You have to save something. Save the first dollar you make, not the last.
Make saving automatic.
Yes. Two, start young. Even small amounts saved early have decades, maybe 50+ years, to compound. That time is invaluable. Three, keep it simple. Don't try to be fancy. Invest in broad, low-cost index funds like an S&P 500 tracker, or maybe a solid, diversified company like Berkshire Hathaway, ticker BRKB. Then, set it and forget it.
Resist the urge to tinker.
Absolutely. Which leads to four, avoid day trading. It just doesn't work for individuals long-term. The brokers make money, you likely won't. Pabrai notes there are basically 0 day traders on the Forbes 400 list. It tells you something.
And the potential is huge, even starting small.
Huge. That example, $5,000 invested at age 18. If it earns 10% a year for 50 years, that could be $500,000 by age 68 from one single $5,000 investment just left alone.
Wow. Okay, keep it simple, start early, be patient. What about choosing those investments if you do decide to pick individual stocks beyond an index fund?
His advice mirrors Warren Buffett's. Fewer, bigger, infrequent bets. Think of Buffett's punch card idea. Imagine you only get 20 investment punches in your entire life.
Makes you really think carefully about each one.
Exactly. Make each bet count. Because the reality is, something like 4% of all listed companies generate almost all, like 90% of the stock market's total returns over time.
Mm.
Finding those is rare, which is why index funds are great. You capture the winners automatically.
So, if you do manage to find one of those huge winners, one of those multi-baggers as they call them, what's the crucial next step?
This is maybe Papre's most painful lesson learned. Circle the wagons. Once you identify a massive winner after you already own it, the key is to never sell it.
Never sell, even if it's gone up a lot.
That's his point. His biggest investment mistakes, he says, weren't stocks that went to zero. They were the mistakes of omission, selling huge winners way too early.
Like the Ferrari example.
Exactly. He owned Fiat Chrysler, which owned like 80% of Ferrari at the time. He sold it after it did well, but before Ferrari was fully spun out and its value just exploded. He calculates he missed out on maybe $1 billion more just from that one decision.
Ouch. So, recognize your huge winners and hold on tight. Let them compound.
That's the essence of it. Defend those crown jewels. So we've really gone through a lot today, haven't we? From this whole Dhandho idea of beating businesses with almost no risk, to cloning, to the incredible, almost magical power of long-term compounding and investing.
Yeah, it really makes you rethink the standard advice about risk-taking and what actually builds wealth.
It does. It's much more about discipline, patience, finding clever angles, and focusing on that long runway, whether it's in business or investing. Less about flashy bets, more about solid foundations.
Absolutely. And it feels like the underlying message beyond the tactics is about mindset, doesn't it? Having the courage to find your music, as Pibri says, and the patience to let these principles work over time. It's not just about accumulating money.
Not at all. He frames wealth as a tool to maximize happiness, to live a life aligned with your passions.
So maybe the final thought for you listening today is, what is your music? What's that thing waiting to get out? And looking around your own life, your own work, where are the potential free lunches? Where are those Dhandho opportunities, those small amounts you could start investing for that long runway? Maybe figuring that out is the best investment to start with. Thanks for joining us today.